I just have to point out, Clem, you and I have worked together for years. I've interviewed you for years. And last year, around this time, you were sounding awfully bearish. And, your call played out quite well for the first half of this year. Now you're predicting 90 to 120K Bitcoin. You're saying the S&P is not going to crash.
Sure,
You're saying the
sure.
economy is going to do better. What changed in the last 6 months for you?
Well, look, there are people that say that it's going down, it's going to be the end of the world, the dollar's going to go,
Right.
buy gold, and it's always bad, it's always terrible, it's always going to happen, but it's always going to be awful. Yeah. There's some people that say, it's going to the moon, it's going to the moon. That's all they say. It's going to the moon, it's going to the moon. In the market, you've really got to be able to know which market you're in, a bull or a bear. All you need to know in the market is which way is it going. And it's been very bearish, and we've seen that. I mean, I was calling down the American market ever since they started QT. You remember me being, it's the end of the world. And then you remember me saying, it's kind of like, And now you've seen me go bullish. And that's because the world's changed, not me.
Clem Chambers returns to the show. He is the CEO of Online Blockchain, and he's got some very interesting views regarding Bitcoin, gold, oil, and the stock markets and economy overall. Clem thinks that oil may go to $300 a barrel and beyond. Why is that? We'll find out. But first, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space. Now, with Bitcoin having climbed to above $40,000 a coin now, some are wondering where to park their profits. An IRA may be an option. So if you're over 18, want to open a new account with cash with iTrust Capital, or roll over an existing account, simply click on itrust.capital/David in the description down below to learn more and get started. Clem, welcome back to the show. Always good to see you.
Great to be back. Thank you.
We spoke many months ago. A lot of things have happened in the market, so let's run through everything. But first, your economic outlook. You were telling me offline that first you think oil could go to $300. I want to touch on that and why you think $70, $80 a barrel is not enough, high enough for you. And you've got strong views on Bitcoin and gold and stocks as well. But starting with the economy, do you think that the economy has, I'm talking about specifically the U.S. economy, but you can touch on the global one as well. But do you think that the U.S. economy is headed for a recession immediately?
Well, I think it's probably heading for the opposite because, after the pandemic, things are, repairing, recovering, however you want to put it. Now, that doesn't mean things aren't going to get tougher. It doesn't mean that, numbers will go the wrong way. But underneath, the baseline is we're in a situation of recovery. And that recovery is going to continue. And at some point, that's going to start to become a little bit of a boom, I think. It might take a couple of years from here. But we're on the road to recovery, and that's the key thing. So it doesn't matter about the oscillations around that. The underlying trend is the comeback from the pandemic.
We're recovering from what exactly? Because we haven't had a recession since the pandemic. So,
if you think about what happened,
right.
Everybody got to sit on their backside for a long period of time and not making any stuff. So there was a lack of wealth generated. Yeah. So there was lots of money pumped into the system, which generated inflation that tided us over. But under the hood, there was lots and lots of disruption. For a start, as I think people miss this. It was like 2 years where nobody was trained. Nobody was trained to be a lorry driver, a carpenter. Nobody was trained to even to flip big bags. Nobody was trained to fly planes. Nobody was trained at all. So you've got this 2-year lump, which is somewhere between 5 and 10% of the workforce that went into retirement and weren't replaced with newly trained, skilled people. Well, that's a massive underlying, grinding away at you, a chronic problem that will take, probably more than 2 years to work out. And that's always going to be a drag. But nonetheless, you're coming back from that. So the money that wasn't made during the pandemic is what we're repairing from. The cars that weren't built, the containers that weren't shipped, the pilots that weren't trained, et cetera, et cetera, et cetera. And that is the pain, the grinding feeling that we're getting now, because you just can't stop the clock like that and expect it to just start up overnight and everything be fine.
Right. So you're talking about disruptions to the supply chain that have been fixed and repaired. What about economic output? Are you expecting that to increase then if you think we're on the path to recovery, just generally speaking?
Yes. Yeah, we are definitely on the path to recovery. But I think a lot of people have lost their faith in the accuracy of the numbers that you look at. So if you're to believe some of the numbers, or at least some of the press releases that come out from various governments, oh, we're back to where we were before 2019. Well, that might be true. It might not be that accurate. But also, we've lost the 2 or 3%, or 1 or 2 or 3% growth since then. So we would be ahead, 10% by now. So there's still that to come. There's still that recovery to come. And, it's good to be in a recovering situation because you're going in the right direction. So it's just a matter of gritting your teeth. And it's better to come out than to go in with these sort of trends. And of course, over time, it plays to people who are brave enough to put their best foot forward.
Do you think that the unemployment rate will continue going up?
Well, I mean, it's to me, unemployment in America is like interest rates were. When I was a kid, everybody would think this was overemployment. And now unemployment's going up, but it's been incredibly low.
So you're saying that a change of a few basis points isn't going to make a huge difference, even though the trend could be up. It still underlies a healthy economy. Is that can we use that as a summary?
I mean, I think the American economy is extremely healthy considering what the world's been through. And employment is really strong considering what the world economy has been through. I mean, a lot of people, and this is not really a very popular thing to say, but a lot of people do nothing but kick, say, the Fed. Oh, they're doing this, they're doing that, they're creating inflation, oh, blah, 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 blah. Oh, it's terrible what they're doing. If they hadn't done what they've done, it would have been a catastrophic. I mean, there would have been way, 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 way more people unemployed. There would have been absolute devastation financially. So, if you realize what happened, for right or wrong, the world stopped for however many months that was. Actually, if you took all the, can't go to work properly, nobody's there properly, can't get stuff properly, have to stay at home for these weeks, can't go there, can't go on holiday, can't fly, etc. And you could press that down to how many months of lost production that was, lost money. It's like all those shops that were shut and didn't open, all those restaurants that weren't serving food, that lost money. That's gone forever. And coming back from that is really a mighty task. But the progress is relatively good. And we're through the worst of the worst. And now we're in that gritty period of climbing out of that valley. But of course, that's good economically and good for investors too, potentially.
So then looking ahead, you're expecting then the economy to continue growing. What does that mean for interest rates? The Fed funds
well, I think continue to come back. Now, if you look at interest rates are going to come down at some point, probably later than sooner. But, inflation was created to fill it in the hole, to as a sticking plaster over, all the problems from the pandemic. And that caused inflation. And, governments are allergic to inflation over a certain rate. And so the Fed is clamping down on money supply, and it's doing that through quantitative tightening, QT. And there's a good indicator of how much extra money there is in the system. And that is called the reverse repo, which is where banks go, this money I've got, that kind of you gave me, I've got no use for it. I'm not going to have it sat around doing nothing. I'm going to give it back to you, the Fed, to look after for me, and you're going to pay me a rate of interest. So the reverse repo is how much extra money there is in the system that the banks can't find a use for. So that's like hot money. And rather than go around and give it to the likes of me to have a wild party in Vegas, they give it to the Fed and they get a rate of interest on it. Now, that balance is normally zero. But over the last year or two, it's been huge. But that's coming down really fast, really, really, really fast now, because the quantitative tightening is sucking money out of the general system. And then when the banks are getting a little bit short, they're pulling it out of the reverse repo. They're saying, oh, by the way, Fed, give me that money back. I've got use for it now. Now, by about March or April, it's all gone. It's zero, which is a heavy suggestion that money supply will be back to where it should be, and therefore inflation will soon be gone, and therefore they can switch the money printing back on again to get the wheels going.
I'm going to come back to inflation. Let me just ask you the next question this way. So you brought up Vegas. What would you rather do right now? Put $10,000 on a roulette machine in Vegas, or put $10,000 long the S&P 500 at current levels?
Well, one I know I'm going to lose on.
Which one's
and
that?
the other one is Las Vegas. No, no. I mean, at the end of the day, which way are the odds stacked? And the stock market, the odds are stacked in your favor by about 7% a year in the long term. So that's like playing a roulette table with a 7% payout. So you play that all day long, which everybody does play it all day long. Now, the other thing to bear in mind, in my opinion, the powers that be, the government, the Fed, people like that, they navigate by two indicators, the only two that matters to them, which is the stock market, because that shows you how good the economy is doing, and house prices, because they got them as well. And that's where most people's wealth is. So, when things are running too hot, they would sit on stock prices and they would sit on houses. And when things are not running hot enough, they would try to promote that by doing things like printing more money and lowering interest rates. So they could look at house prices and they can look at the stock market to see how well they're doing. Now, what they don't want is a stock market crash, because that creates such cataclysmic loss of money. They want it to kind of hold at these sort of levels because they want a stable ship. House prices, that's very illiquid money. So, people don't, run around buying and selling the houses that fast. So they don't mind hitting them quite hard, because that is something that is the trickle-down effect. So if you turn down the trickle-down effect, not many people notice it's not trickling down. So those are the two things that they look at. So I'm expecting there to be a sort of, the Fed put is the classic idea. And it's in and around the sort of range that you're seeing now. So I don't expect anything amazing to happen to the S&P 500. I don't see anything terrible is going to happen to the S&P 500. I would buy the dip if there was one. And, if you buy good companies and you're a good investor, you'll do just fine. If you go around chasing the next hot thing your mate told you about in a bar, you'll lose your shirt. It's the same old, same old.
If the Fed cuts rates next year, and if they go as far as to re-engage QE like you suggested they might, wouldn't that bring in a new high for stocks?
It could happen. You see, what creates inflation is if you pump money into the system to people who don't have money, because they need to spend it. Not only do they need to spend it, they like spending it. So if you give money to a rich bloke, he's going to go, what am I going to do with that? So he puts it in the bank lends it out, and the wheel of the economy goes round. So in essence, they will try to, when they re-inflate, so to speak, they'll go back to the old QE model of giving it to the rich, not to the poor. The trouble with what they did during the pandemic was that they handed the money out to the non-rich, who went and spent it. And, if you lock up that money in the stock market, in crazily valued companies like Apple, and in houses, it doesn't go straight down the supermarket and buy Coca-Cola. It sits in those assets looking really good, making people feel great. Maybe they borrow a little bit of money against it, but it's not liquid. It's not very liquid. And so it's a good way of promoting an economy to stick this new money into illiquid assets. That's what QE and QT is all about. It's about managing liquidity. Because if you take liquid funds out of the system, it stops. If you put it back in and you put too much back in, it runs too hot. But if you take illiquid money, it really moves so slowly that it doesn't cause the sort of retail inflation that you see. It causes rich asset inflation. So rich man's assets go through the roof. Mansions go from being 2 million to 40 million and stuff like that. But on the ground, it doesn't have that much effect. It's a good old trickle down. And that's been the clever trick they've been doing now for over 12, 14 years. And they went beyond that during the pandemic, and that's where we've got the inflation. They pull it back out again. And when the money supply is back in balance again, when they do reinflate, they'll put it back into stock market assets and real estate. So yes, it won't be bad for equities for sure.
Well, since you brought up real estate, if it won't be bad for equities, what impact would it have on the residential real estate market?
Well, I'm sure it'd be pretty good too. I mean, I don't really follow US real estate, but I certainly see there's a lot of mansions being offered to me right now, and they look like they're quite a deal. I mean, whoa, look at that place. Yay, half price. So clearly there's been a pretty heavy effect, but, I live in Monaco. I don't pay tax. So living in an American mansion fills me with terror.
does the following logic make sense? So I've heard several theories as to why the real estate market hasn't collapsed yet in the States, despite multi-decade high mortgage rates. Now, one of the theories is that, well, people have locked in their rates, and so the rising rates doesn't really affect them directly because they've already locked in lower rates. They're not going to refinance until maybe next year or later. If they were to buy a second home or sell their existing home, they're going to have to finance at a much higher rate, which prevents people from selling. Suppose rates were to come down next year. Wouldn't that incentivize selling? Which would ironically mean that rates coming down would mean lower home prices. Does that make sense?
Yeah, not really.
No.
So, I mean, the thing about prices, and it's the same with college education. The moment you lend people money to do things, the lower the interest rate, the higher that asset gets. So, if you go to people, yeah, we're not lending you any money, you've got to go to college, you've got to find the money somewhere, you've got to wait tables. They can't charge much. The moment they say, yeah, 100 grand, yeah, go do that, study, yeah, here it is, pay it back over the next 40 years, young person, they'll go out and spend it. And of course, everyone will put their prices up. Yeah. So house prices are absolutely directly linked to the cost of money. But it's that illiquid asset that I was talking about earlier. It's illiquid. So people go, ooh, scared now, but I'm fine. I've got my fix in for the next 35 years. Well, I'll just sit here then, won't I? It's only the people that can't make the payments and get bombed out, or people that have to move, well, really have to move, not just, I want to move, that get affected by that. They will sit on their hands. I mean, you can see that back in 2008, when things cratered in Europe in property, the banks bought it all. They just didn't sell it. So the prices didn't collapse because people just bought it up and sat on it and waited for the sunny day to come out. It's illiquid. Its liquidity is slow. And therefore, the effects of tightening, the effects of high interest rates, particularly on a fixed rate mortgage, is quite low. If you come to the UK, well, we give you a fixed rate mortgage for 3 years. Oh, can I have one for 20? No. Oh, well, what happens at the end of 3 years? Come back to us and we give you a new one. Oh, that's reassuring, not. Yeah. And it's having a much bigger impact there because there's all these people staring at 18 months. They're going to go from 0% to 6%. And, I would never buy a house in the UK because you can't get a fixed rate mortgage for 20 years. You have to get it for 3. It's an absolute joke. Whereas you can go to other countries in Europe, buy yourself a castle and get the same rate for the rest of your life. And, that is gives you security from boom and bust. But ultimately, the price of assets is down to the cost of the money to borrow to get them.
You could buy a castle in Scotland or a 1-bedroom apartment in Manhattan for the same price.
No, you're joking. The 1-bedroom apartment in Manhattan is way more expensive. I mean, I'll give you one in Scotland if you ask nicely.
I'm going to shift gears now. You wrote a recent article for Forbes, I believe, about oil potentially going up to $300. Let's summarize that article for us. What were your findings? What's your thesis there?
Well, there was a very fabulous piece by the IEA, International Energy Authority, which is basically like the World Bank. So it might as well be the world government. And they said, hey, guys, never been more coal mined this year than ever before in history. Never had more coal being burnt. By the way, it's not you. It's China and India and Asia that's doing it. And they're not slowing down. They didn't put it like that, but that's what it said, which means that, global warming, ice caps melting, polar bears drowning, sea levels rising, everybody dying, that's not turning around. Net zero may be on a Tesla near you, but not out there in Asia. They're burning coal, dirty coal, like there's no tomorrow, and they ain't going to stop. So consequently, that means nobody in their right mind is going to stop burning oil, because oil is way less bad than coal when it comes to CO2 and all that good stuff they sing about all the time. So the reality of the matter is coal is going to be burnt at a record level and oil is going to be burnt at a record level too. And it's not going to go away, because if you're going to get rid of coal, what are you going to use? You're going to have to use oil next, aren't you? And then if you can get rid of oil, you're still burning, natural gas. So there's a sort of hierarchy of dirty or not dirty hydrocarbons. But before you can get rid of the rest of them and oil, you've got to get rid of coal. And coal has never been more popular. out east. So oil, as everyone tries to pull out of the post pandemic mess, you need cheap energy. And the other thing is, hey, I'm here in Europe or America. I'm going to compete against these Asian guys with the cheap labor. Yeah. And they're using coal, which costs nothing. Yeah, I really want to use expensive energy because I want to go bust. I want no growth. So everybody has to use, quite cheap energy, really, really, really cheap energy, actually. And again, we're back to coal and oil. So forget coal. Oil is going nowhere but up. Yeah, so it's not going to become an orphan commodity like they were saying a few years ago. It's going to be the opposite. Now, if you look at the price of oil a few years back, $140, $150 a barrel at the high, and then you start rolling in a bit of inflation. Well, you can roll in real inflation or unreal inflation, whichever inflation you like, and then project that out 4 or 5 years. You're getting in the $250s to $300 without there being an increase in demand, without there being, Russia in the doghouse, without there being a war in the Middle East. And of course, everybody freaks out when they hear that, oh my God, oil, $300 a barrel, oh my God. But it was $140 a barrel off the top of my head about 3 years ago. And, how many things do you know have doubled in price in those years? And, give it a few more and the likelihood is even greater.
It also went to negative for a brief period of time.
Sure. Yeah. Absolutely.
So wait, you said that.
So did humanity at roughly the same time.
You're okay. I understand your demand side of the thesis. So we're still going to need oil for all the reasons you've stated. You're then assuming that supply will dramatically increase to outpace the growth of demand, right?
Well, I don't think supply is going to explode. I mean, they're already drilling to the edge of the crust, and the cost of it and the demands of and being allowed to even do it in some places in the world. It doesn't, there's going to be no sudden glut of oil. I think there will probably be rising production because the oil guys are really, really, really brilliant people. And, they get up to some amazing things, walking around on the bottom of the sea and operating in minus 50 and all that stuff. That, they will make it if they can. But nonetheless, you've got, 3 billion people coming up from poverty, all need energy. That's why they're burning the coal. They're not burning it because they want to breathe in smog and pollute the environment. They're doing it out of necessity. And that necessity is not going to go away. So, the demand is only going to go up.
Well, you said that should oil move towards $250, $300, that's an inflation adjusted number. Well, but
just to give you an idea of that, it's not that difficult.
Right.
I mean, a lot of people that read the article got very upset, but I mean, it's really not that far away.
But wouldn't higher oil push up inflation? I mean, isn't that a chicken and an egg problem? Which has to come first? Well, oil is going to cause the inflation, isn't it? Yeah.
It's very difficult to know what inflation has already been, let alone what it's going to be. I mean, you look at the numbers, you go, really? That's not what I see when I go out and I do this and I do that. So ultimately, commodities are the best judge of real prices. And, if you have a economic downturn because of something like the pandemic, yes, their prices will fall. But when it all goes back to normal, all that inflation will slowly have seeped through the system so that it will actually reflect in the price. Because, if somebody says, I'm going to go on strike, I'm not going to make cabbages anymore because I'm not getting enough money to keep my family, and the cabbage man gives that guy an extra 25%, it only affects cabbages. For that effect of cabbages to go through the whole economy takes a long time. There's a significant amount of lags. But if you look back at the history of things, give it enough time, it comes out, it washes through the system, and you get to see the real impact of that inflation. You see it in the supermarket, but you're not seeing it in here, you're not seeing it there. That all washes through. You'll see it in the end.
$300 is going to make not just the commute to work unaffordable for a lot of people, but also bring up the fixed cost for a lot of industries that require oil as an input. It's going to kill the economy, would it not?
You say that, but for example, if you buy gas in the UK, only about 15% of that is the cost of the oil. The rest of it's tax. Yeah. So the energy input is significant factor, but it's not overriding. I mean, when you're doing your commute to work and you're looking at how many dollars on the gas pump, I don't know what the numbers are in America, but it's still a significant amount of that is tax. You know, it's $1 a gallon in the Middle East, you know, where they dig it up. And, you know, $1 or two, not $5, $7, $10, $12. So, you know, and also when you start to think about it, you're just used to getting it cheap. You know, it's so you'd have to be a bit more careful with it, like you're a bit more careful with lots of other things that you spend money on. But, you know, people would adjust for sure. But it's not a question of whether they like it or not. It's a question of whether it's going to happen. And I see that it's probably likely to happen.
You're absolutely right. It always astounds me how the government comes up with clever programs to reduce the price of oil or gasoline at the pump. All they have to do is reduce the percentage of tax
Boom.
on the said commodity. But you know, I
Yeah,
guess
but how likely is that? Oh, yes, we're going to take less money. Yeah, you know, you always know whenever in investment you start to see percentages, you always know that the chances of being scammed is high. The more of a scam it is, the more it's about percentages. The less of a scam it is, the more it's about hard numbers. We're going to charge you $1,000 in tax for this. Oh, okay. We're going to charge you 3% of your property's value.
No, well, the government needs to make money somehow. Except
yeah, it's not just them doing that, by the way.
except the countries that don't charge tax. You know, I wonder how they're getting their income. How does it work in Monaco? How does it work in the UAE?
They tax corporations, not individuals.
Right.
That's how they do it here. And they have licenses and stuff like that. So they still have revenue. And they do it on property tax, big property taxes here when you do a transaction, big transaction taxes on property. But, you know, when you look at waste, then you get a feeling for where the money goes in countries. And of course, you know, if you just had infinite amounts of money pouring in to your bank account, David, which I'm sure you're used to, you know, you're just a little bit freer and easier with your spending than you would otherwise be if you had to count your pennies.
I am used to it. Then I woke up from that dream. I want to move on to an article you wrote recently called "Writing the Bitcoin Parabola: 5 Strategies to Protect Your Profits." I'm going to read the 5 strategies that you wrote. Some of them might be in jest, but I'll read them regardless.
There's only one really in jest, which is the one which is you could ride the whole thing up to the moon and back down to the turf.
That's the last one. Number 1, jump off early. Number 2, wait for the top and get out on the way down. Number 3, sell bits of your positions at levels until it's all gone. Number 4, sell the dull stuff off when you start to sweat your profits. Then take a chunk of the profit and go gambling with it on the hope the rally will continue by buying the spicy stuff associated with the rally in general. Number 5, ride it all the way up and all the way down and cry about it for years. You said that you generally prefer 1 and 4, which is to take profits.
Yeah, the way that it works with these bubbles, I mean, you remember 2000, you were at school probably then, but, you know, it goes up like a rocket, down like a rock. Yeah, and that's what bubbles do. And Bitcoin is the perfect example of that. Stocks do that too. And very rarely do they not go up like a rocket and come down like a rock. You get a few, you know, the apples of this world. But, you know, pretty soon you're sat there and you're sitting on big profits and you're waking up at 3 a.m. checking the price. And you're going, oh, no, what am I going to do? I've quadrupled my money and it's going north and I'm making so much and I'm terrified that it's going to turn around and I wake up in the morning, it's all gone, right? Because these things, the parabola like that, up like a rocket, down like a rock. You wake up one morning, it's halved. So nobody knows the top of these things. Nobody knows the top. And I'm sure you've all seen charts that do that. Big spike, crunch, bang, wallop, and then gone away again. So I personally, as soon as I start to sweat it, and I've learned to be greedy over the years, but not too greedy, I set my target. When it goes through, I get out. I don't care if it's going from 38 to 60, like Bitcoin did 1,000. I got out of 38. Then what I did is I took a little bit of that profit and went, right, 20% of this profit is going to go into the crazy stuff, not the Bitcoin, not the Ethereum, but, you know, the crazy stuff you've never heard of. And let's see where that goes. So, you know, you buy Matic at 3 cents, it goes to $4. Well, actually, I got out at 25. But, you know, you're still making good money and it's all insane and it's all crazy. But you've banked 80% of your profit and now you're playing the same game on the same vertical with less money and, you know, letting it ride. And because it's the spicy stuff, rather than the Bitcoin doubling, it goes up 10 times. So you can afford to do it on smaller amounts. Now, obviously, if you're a greedy swine, you can just go all in until you kill yourself. As they say, bulls get fed, bears get fed, pigs get slaughtered. So, the pigs get slaughtered. You don't want to be one of them. The other way, and I can never do this, is when it goes up on the vertical, you just sit there. You just sit there and sit there and sit there and sit there and sit there, and you just let it go. And when it starts to crash, you get out. Because you would have got out a lot earlier. And so you lose 20%.
What do you mean when it starts to crash? I mean, cryptos moved like 20% in like an hour. So like when
but and then it will go up 10%, it'll go down 8%, it'll go up 15%.
Right.
If you look at the top of these markets, there's normally a jagged top.
Okay.
Yeah. So rather than say, I've had enough, I've done fabulously, goodbye, which is what I tend to do, you go, let it run, let it start to crash, and then get out. Because it never, you might have doubled your money because you would have got out halfway up. So
I've noticed you don't have like you didn't mention one should have a target price in mind. And maybe I like you to comment on this, please. You haven't told me, you know what? I think it's going to go to $50,000 for whatever XYZ reasons. I'm going to wait till it gets to 50. I'm not going to touch it till it gets to 50. I don't care if it goes to 75. I'm taking profits at 50. Right.
Well, I thought it was going to 40. So I planned to get out at 38.
Okay.
Yeah. Simple.
Okay.
And it went to 60. Yeah. So when I got out of 38, all covered in sweat and gold, I thought, right, it's probably going to go up from here. Take 20%, buy the miners, the minor ones, the crazy stuff, the ones that I like, and see what happened. And then I got 10x on 20%.
How did that make you feel? How did that make you feel emotionally and psychologically that you got out at 38,000, but it went up to 65 and change? So you missed out on 80% upside.
It made me feel richer.
Okay, that's a good answer. But you're not. It doesn't. You don't stay up at night thinking, "Oh, I missed out."
Oh, never do that. Oh, never do that. That's you shouldn't be in the market if you think like that.
Okay.
There's always another bus coming.
Well,
here it is again.
Okay, so where's this current bus headed? We're currently at there was a huge run up, as you know, in the last 4 weeks. Bitcoin is looking good, above $40,000 a coin. A lot of people told me it wouldn't even breach 35. So,
I've been very bearish on Bitcoin, and I've been writing articles saying I'm bearish on Bitcoin. SEC, this is all nasty, but this chart is ridiculously strong. I mean, it's ridiculously strong. Just if you want to be in, if you believe in it, then dollar cost average. This is the way to do it, and that's been a good way to actually do it. And I look at the chart, and I look at the way it's behaving, and it's got 90 to 120,000 on it. Maybe middle of next year, or during the halvening. And I look at that and I go, I mean, for me, there's all sorts of problems with crypto. One of them is custodianship. I mean, where do you put it all? It's okay mucking about with 6 figures, but the moment you get into 7 or 8, I mean, you can't go out. You have to have bodyguards. It's really, really difficult. Or you could put it with FTX, of course.
I just have to point out, Clem, you and I have worked together for years. I've interviewed you for years. And last year around this time, you were sounding awfully bearish. And, your call played out quite well for the first half of this year. Now you're predicting 90 to 120K Bitcoin. You're saying the S&P is not going to crash.
Sure,
you're saying the economy is going to do better. What changed in the last 6 months for you?
Well, look, there are people that say that it's going down, it's going to be the end of the world, the dollar's going to go buy gold, and it's always bad, it's always terrible, it's always going to happen, but it's always going to be awful. Yeah. There's some people that say, it's going to the moon, it's going to the moon. That's all they say. It's going to the moon, it's going to the moon. In the market, you've really got to be able to know which market you're in, a bull or a bear. All you need to know in the market is which way is it going, right? So if you think it's going up all the time, you're going to be wrong half the time. You're not going to do very well. If you think it's going to go down all the time, you're going to be wrong half the time. You're going to do very well. You've got to be able to pivot, and you pivot on what's going on around you. So yes, the SEC is jumping up and down in everybody's head with Bitcoin. It's going to go down from 60 to 13. Well, it hit 18, and I did get my extra 5. And then I started to grumble about it's looking a bit, it's looking like it's the bottom here, and it's looking like it's going to go up now, and still don't like it. I still don't like the SEC. I still don't like any of that. But it's looking a bit bullish now. It's bullish. I don't have to want to buy it, but it's looking bullish. Yeah, the market's changed in the UK where I play the most. The moment inflation came off the high was the moment the whole market changed. It just changed overnight like that, bang. And when you are in a position that's well thought out, and the market goes up and it doesn't go up much, and when it goes down a lot. You're running against the grain, and you know that when the market goes up and your portfolio of which you've picked carefully goes up more, and when the market goes down, it goes down less. You've on the right idea. So you have to watch the market. You have to go. You have to go with what you see, trade what you see, not what you think, and you have to adapt to the incoming information. And it's been very bearish, and we've seen that. I mean, I was calling down the American market ever since they started QT. You remember me being, it's the end of the world. And then you remember me saying, it's kind of like, And now you've seen me go bullish. And that's because the world's changed, not me.
Okay. Very good points. I understand that. On that note, let's end it on gold. You wrote another article. Is gold to $2,200 and beyond achievable? So you posed that question. Why don't you spoil the answer for us?
I'm going to spoil the answer for everybody, actually, because it's the world's simplest chart. If you sit people down and say, there's some useful stuff in these stock charts. It's not all mumbo jumbo. Here's a simple one. What do you see? And you show them the gold chart. You'll see this series of highs, high over a long period of time. And it got back to that high, or getting back to that high. And I said, if it goes through that high, any significant amount, it's going to go a long way. Well, it hasn't. It hit the high, the highest high, and now it's come off again heavily. That is still the fact. It's range bound. It has to break out of that range. And if it does, when it does, it will move quite a long way. I mean, a long way. So it didn't. Now, it doesn't mean it won't do it tomorrow or the day after, but it failed to crash through the roof and go on a vertical, because it should, because we've had all this inflation. The trouble is with gold, they keep making quite a lot of it. They make it depends how you count it, but it's about 2% of all the gold in the world is newly mined every year. And when you think how much of that gold is lost or locked up in boxes in banks or in people under people's bed, the actual free flow of gold is it's not necessarily that huge. So it is actually quite diluted. It is, the supply of gold as a ratio of what is actually liquid out there is actually quite high. And that is a drag. But we've had all this inflation. It should want to go on a run. But it nearly did. It still can. But until you can look at that chart and see that it's gone through that roof, as Bitcoin did, then you've got to take it with a pinch of salt. Again, it's a dollar cost average bet. Just buy a little bit every month and just stack it, and then one day your prince will come.
As we're speaking today on the 11th on Monday, gold is down 1%. It was above $2,000 last week, and as you know, it went up $100-something and it came back down.
It did a classic spike as well. It spiked really sharply, which is normally a bad sign.
What is it about $2,000 that just is this just psychological ceiling it can't seem to maintain above?
Well, people like round numbers, and prices are attracted to them because of that. Because people say like, when it gets to 2,000, I'm going to sell, or when it goes through 2,000, I'm going to buy.
So
people can, they don't like decimal points, and they don't like things. They like simplicity, and it's the simplicity that drags prices towards round numbers. But normally, if you take any level, a price will go through it 4 or 5 times on average, backwards, back across it, backwards and forwards. So it's you need to get decent clearance. I mean, think about charts. If you look at a chart and you see something that's really obvious, then that's something you need to pay attention to. If it's just a load of noise, which most charts are, because that's how markets work, then it's a load of noise and there's nothing to be seen.
So when you say clearance, what are you talking about? It has to sustain above $2,000 or $2,200 for you to feel bullish?
I mean, a few days above the previous high.
Okay.
Or a $100 break above it. A couple of, it's one of those things that you look at it, you'd see it and you go, oh, that's done it. Oh, look at that. But the point is, when it does it, you might say, oh, I've missed it now. But you haven't missed it. I mean, it could run $1,000. Those ranges, when you've got a long-term range and it's not going anywhere, it won't break through. When they do break through, they run for a long time. And so one of the good ways to, if you are going to trade, is find something that's dead as a doornail and it's just going. When it breaks out, either way, it doesn't matter up or down, it's on a run, and then you can jump on that run. And we've seen that with Bitcoin. Gold has given it a go, and it's a very good thing to keep your eye out on. You've had a stock; it's a good business. Nobody cares about it anymore. It was great 5 years ago, and now it's dead as a doornail. But it's still a great business, and it's ticking along, going nowhere. Suddenly, it starts behaving differently. Well, something's happening, isn't it? So it's the same with all financial instruments. When something kicks off, if you've got your eyes on the ball, you get an opportunity to play the game.
Could you summarize your outlook for us? I'll close off on this question for next year. Your most bullish and your most bearish assets for 2024.
Bullish and bearish assets. Ooh. Well, I do think there's a very strong chance of a very good year for crypto.
Okay.
Now, I'm playing that through equities. So rather than actually hold Bitcoin and Ethereum and, wondering where I'm going to put my USB stick or what bank account I'm going to have to nail it in the safe deposit for and all that nonsense, I prefer to hold that through equities because equities will move. So the crypto equities is a place that I'm staking out. So I think crypto equities will do well alongside crypto itself. I think the market will be good. I mean, it's a game to play. It's not. There's nothing really bad coming. So if there was a dip, you'd buy it, and if there was a rally, perhaps you might unload a little bit. Swing trading, and I think really outside of that, and gold still is on the brink, and flattering to deceive, no doubt, but it's still worth dollar cost averaging gold, I think. So market positive, economy grinding away up. I mean, 2 to 3 to 4 years of positive economic activity. So that really, really is a good prospect in my book. So 3 or 4 years to make good money. So, that's how I'm seeing it. So next year will be better than this, and the year after will be better than that, and so on and so forth for quite some time, leading into probably a boom at some point. And thing to bear in mind is it doesn't matter who wins a presidential election, seeing that you reckon it's between Biden and Trump, because none of them are going to get re-elected after that. So normally at the beginning of a first term, there's a clamp down on the economy move so that the last 2 years of the presidential reign, so to speak, they can pump it up. But, that won't happen this time because they're both on an end run. So there won't be any political interference with economics, I don't think, over the next couple of 3 years. So that's also good because no one can mess things up better than politicians.
Good points. Thank you very much, Clem. Where can we learn more from you?
Well, I mean, you can read my stuff on Forbes. You can read my stuff on Seeking Alpha. You can buy my books. You can hang out in David's YouTube channel.
Fantastic. Well, we'll have you on again, and you can hang out here and watch more of our discussions. Thank you very much, Clem. Appreciate your time. You ran through everything.
That's my pleasure. Or you can take me for a drink in the casino at Monaco.
Appreciate it. Thank you very much once again.
Bye-bye.
And thank you for watching. Don't forget to subscribe and like this video.